All right, let's go ahead and get started. Good afternoon and welcome to today's educational webinar session with Options Play and First Trade. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today we are going to go over trading this upcoming earnings season. So earnings season kicks off technically on Friday with the major banks as usual. So a big question that many traders or users ask is, how do I navigate through earnings? Is it something that I should avoid, or is it something that I should go ahead and gain exposure to? And the answer to that is really down to your risk appetite. When it comes to earnings, there's definitely more of a gambling factor involved, and that's because there's going to be a large expected move a large move after the earnings announcement for a number of reasons. Either could be revenue numbers, EPS numbers, or most importantly, forward guidance. So forward guidance is, in the last few earnings seasons, has always been um, the biggest mover. Like a lot of the time, you see companies beating their EPS and revenue targets, but the forward guidance is poor, and we tend to see a big decline in the stock. So, like I said, earnings can be a bit of a gamble because there's a very uncertain outcome, but there are ways to gain exposure to earnings using types of strategies that can help mitigate your risk and really maximize your directional view of where you believe the stock will head to after the earnings announcement. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only, and examples do not include any commissions or fees. So our agenda for today, kicking off with Q3 earnings review and a preview of Q4 earnings, what the general expectation is heading into this earnings season. We'll take a look at the fundamentals. Just a brief look at how you should approach your fundamental analysis for earnings season. From there, we'll be moving on to the strategy section of the webinar. So calculating the implied move with the straddle. That is always the first step of an earnings trade. You want to know what the market is implying in terms of the move for a certain security ahead of the earnings announcement. From there, we'll take a look at a different strategy that you could use if you have a directional view, and that is a debit spread strategy. We'll also take a look at the credit spread strategy and the advantages of using a credit spread strategy. And while we discuss these strategies, we will be going through an actual example as well. So the main question I want to help you answer today is, how can I trade earnings season with confidence and maximize returns using options? So before we take a look at the strategies, we need to quickly dissect what to expect for for this earnings season and take a quick review of the last quarter's earnings season. So during Q3, 82% of the companies beat estimates for EPS, which is quite significant. We did see during the Q3 earnings season that stocks were rallying across the board quite significantly. We had a big rally heading into the Christmas period, and a lot of that was due to earnings and not just a more dovish Fed. We had a strong performance from financial, discretionary, technology, and communications. And on average, there was a 0.7% revenue beat compared to analyst expectations. Now, heading into this earnings season, analyst expectations are more pessimistic due to recession fears. Obviously, we had elevated interest rates during last year, and that is always going to have a negative impact on equities. So analyst expectations are actually quite low heading into this earnings announcement. However, when you take a look at 2024, the analyst expectations are actually quite high towards the end of the year because of interest rate cuts, and that is going to obviously have a boost for consumer spending and naturally boost EPS and revenue trends. So even though we are having a pessimistic approach for Q4 earnings for last year, we're actually looking at a very big reversal of that for 2024. We are expecting a 1.3% EPS growth rate on average, and five sectors projected for year-on-year earnings growth. Communications, utilities, and discretionary are just some of them, but we also have included in this is actually technology and staples. So those are the five sectors that analysts have eyes on in terms of our performance. So looking at the fundamentals and how do you approach fundamental analysis? Now, the truth is there isn't a golden rule here for looking at fundamental analysis. And what I'm going to do is just provide some guidelines as to what we look at. And it really comes down to two things: valuation and profitability. So valuation gives us an indication as to how much the company is worth. Is it overvalued or undervalued? And you can compare it to its own historical average. You can compare it to, of course, its peers and the industry average as well. And usually you want to look for bullish ideas for companies that are slightly undervalued. Now, there is a caveat to that because you don't want to, you need to know why it's undervalued, and you need to make sure that there isn't any clear red flags as to why this company is undervalued. Do they have a very high debt to equity ratio? Are they is the forward guidance quite negative? Is that maybe why they're undervalued? So you have to answer those questions and not just simply look at oh, this company is undervalued, therefore I'm going to enter a bullish trade for this earnings announcement. But the general rule of thumb is you want to look at things from a valuation perspective where companies are slightly lower valued for bullish ideas. So slightly undervalued for bullish ideas. And profitability is also a big one. You want to see, especially in the case of growth names, profitability is something that's very important because for a company to justify high valuations, it needs to have a high revenue growth rate. Otherwise, it doesn't justify those high valuations. So that's how you would trade. That's how you'd want to look at high growth companies, high beta companies that are probably overvalued against this in the industry or sector, but are showing plenty of promise in the future. That the profitability metric is what you're looking at. So like you're looking at revenue, the 3-year revenue growth, net income, and even operating margin as well, of course. Now, it's important to understand how a company generates income and preference profitable ones. You can always look at previous earnings announcements, and look at the profitability metrics on them and how the company has grown its earnings and revenues. But most importantly, and I see many traders doing this too often, is that they tend to use earnings as a gambling period and simply trade earnings announcements on companies that they really don't know. They don't understand what their revenue streams are. They don't understand properly what the company does, and they don't understand the industry outlook. That's very important. You need to understand the industry outlook. The one thing I'll say about that though is a lot of the times that the market has already priced in the industry outlook ahead of the earnings announcement, but it's still important to understand. Okay, if the industry has been performing poorly and is set to perform poorly, do I really want to have a bullish trade on the stock? It may work initially, but then what happens if I keep the trade open for a few more days and stock continues to decline? So that's why you want to have more things or more variables in your favor. Like I said, you're looking for lower than average valuation with faster than average EPS growth as well, and positive revenue growth over the past trailing 12 months. These are for bullish ideas. So yeah, all in all, when it comes to fundamental analysis, we all have our own way of doing it, but you just want to look at the general health of the company. You want to understand what the company does and how they generate revenue, and you want to understand the sub-industry outlook as well. Now, moving on to the more technical aspects, and we have JP Morgan here. JP Morgan is announcing earnings on Friday, I think. Definitely, it's either Friday or Monday. My apologies, I should know that. But um, what I want to point out is relative performance. Now, relative performance is really the stock's performance against its industry or the broader market. Now, in this case, we're looking at the financials industry, the financial sector, and we're comparing JP Morgan's performance against XLF, which is the financial sector ETF. And if this chart moves higher, basically it means JP Morgan is outperforming its sector. And if it moves lower, it indicates underperformance. Now we've seen a strong period of outperformance here on the weekly chart, really from the second half of 2023. And JP Morgan is really the best in class when it comes to the major banks, so it's no surprise to see this. But you want to see that strong performance, especially on the daily chart as well, heading into that earnings announcement. Now, we have had some underperformance, but overall here, we can see that there's a lot of outperformance for JP Morgan against the financial sector. And again, this is just another variable that you want to see working in your favor if you are looking for a bullish earnings call here on JP Morgan. So that'll be the first thing I would look at. How is this company performing relative to peers or relative to its sector? The next thing you'd want to look at is calculating the implied move of the earnings announcement. Now, the implied move is simply the market's expectation of how much the stock will move after earnings. It's not a directional bias, but it is it's an indication of the magnitude of the move. So it could either move higher or lower. Now, to calculate the implied move, it's actually quite simple. All you have to do is generate the at-the-money straddle strategy for a stock that you want to trade. So the straddle is simply when you buy a call option and a put option that is at the money. So it'll be plus minus 50 delta. And you're targeting the closest expiration after earnings. So in this case, I am looking at, earnings on Jan 12th. So that will be on Friday for JP Morgan. But in this case, I'm looking at the Jan 12th Friday expiration. And it's giving me a cost of 466. So 466 for the cost of the straddle. And that means the market is implying a move of $4.66 in either direction. So, like I said, this tells us how much of a move in either direction the market is pricing until expiration. And from there, we can decide what strategy to use. So the first strategy that we're going to discuss is going to be the straddle. This is when you expect a strong move in any direction. And that's important. It has to be in any direction. And that's why I would say I actually don't like this strategy too much. I prefer to have a directional bias. But the good thing about the straddle strategy is that you don't actually have to be right in terms of direction, but you do have to be correct in terms of magnitude of the move. So like I said, the cost of the straddle is based on two options. Normally, if you're buying a call option for bullish exposure, you only have to factor in the cost of the call. But because you're buying in a call and a put option, you have to add those together, and that'll give you the cost basis of that straddle. And it'll tell us, this doesn't tell us the implied move because we're using a different expiration for this. We're using the March 15th expiration. So it doesn't tell us the implied move. It just tells us the cost of the straddle. And basically, the stock would have to rally or decline more than the cost of this this strategy divided by 100. So it has to rally or decline it has to rally or decline more than the sum of the call option and the put option, is what I'm trying to say. So let's say, for example, you have a stock trading at 100 and you bought the straddle for $10 a share. By expiration, it has to be either above 110 or below 90 for you to be profitable. The target expiration date for an optimal straddle is usually 60 days to expiration. We are going further out because we don't want to be caught up with the accelerated time decay. Remember, we're buying two options. We're not just buying one, we're buying a call and a put. That's double the time decay. So you don't want to be caught up with that. That's why we go for 60 days to expiration. And in terms of the strike prices, you would buy the at the money call and at the money put. So you're looking at around the 50 delta. And you only want to use a strategy when you expect a move larger than the cost of the straddle itself. So that's very important. So you have to expect a fairly significant move. It could be in either direction, but it has to be a big move. Now, when it comes to actually having a directional view or directional bias, that's when you'd want to look at potentially using a debit spread. Now, a debit spread is a lot cheaper than a straddle. A straddle was you were buying two options that essentially doubled up on the cost, right? But for a debit spread, you are buying one option and you're selling another option that reduces the cost of the option that you bought, which will always be more expensive. So I'm sure many of you already know the debit spread strategy. You buy an at the money or around at the money call option, and you sell an out of the money call option if you have a bullish view. And this reduces your overall cost basis and therefore reduces your break even. But when it comes to earnings, because there's so much implied volatility in the stock, the options on that will be quite expensive. That's why you actually want to look at buying a slightly out of the money call or put option. So when you buy the option, you're looking for around a 40 delta. So you're also looking for slightly out of the money. And you're looking again at 60 days to expiration. So in this case, we're buying the 175 call option. And it is a little bit more out the money because we know there's a 170 call option available as well. But that's the reason you want to do that is because it's so much more cheaper compared to buying the at the money that might have a lot more extrinsic value. And of course, we want to sell the out of the money call option. Usually we'd go for 25 delta, but for earnings, you're looking at around the 15 delta level. So all you're doing is shifting your strikes up by around 10 delta. So this should create a much cheaper debit spread and should ideally be around 25% of the width. So in this case, we're buying this debit spread for $2.50 per share, which is 10%, so which is 25% of this $10 vertical width between 175 and the 185 call option that we're selling. So it does allow for a much cheaper debit spread, but it still needs a slightly large move in terms of the magnitude, because at the end of the day, you would still want to be above that long strike, which is now 175 and not 170. But again, because we're expecting a big move and we're expecting a big move to the upside, that's why the slightly out of the money debit spread is just a much better risk to reward as opposed to looking at an at the money debit spread that's just a lot more expensive. Okay, moving on to the optimal credit spread. So the optimal credit spread, is probably one of my more favored strategies when it comes to earnings. And the reason for that is because there's a few more things working in your favor. So firstly, this is when you expect a moderate directional move. You're not expecting a large move to either side. You're expecting price to maybe jump a little bit, but not really make a significant move in either direction. And this strategy is pretty much the optimal strategy for credit spreads because we are looking at the 45 days to expiration. We're selling the at the money call, which is a 50 delta. In this case, we're selling the 170, put, we're selling the 170 put, and we're buying the 25 delta put, which is the 165. So this is a $5 wide credit spread, generates $1.82 per share in terms of premium. And you want to make sure that's above 33% of the vertical width. So 182 is slightly above the 33% threshold in terms of this $5 wide credit spread. So that would be the optimal credit spread. And this strategy is better suited for a neutral move, but it can also suit a large move in your favor, because let's say, for example, um, JP Morgan did rally and rallied significantly. You would have made a lot more money by utilizing a debit spread in this scenario. However, um, you're still not losing money from this credit spread. So there's a slight opportunity cost that you forego, but at the same time, you you how do I say this? You're essentially benefiting from two out of the three major trends in the market. The major trends are bullish, bearish, and neutral. Credit spreads are profitable when in two of them, because if I'm using a put credit spread in this scenario, if the stock moves higher, it's profitable. If the stock stays neutral, it's profitable, but it just takes longer to realize those profits. And it's only if the stock declines by quite a bit. Usually that would be the break-even price would be the short strike minus the premium received. If it declines by more than that, that's when you start to experience a loss for the credit spread. Now, the second reason why I like a credit spread is because earnings earnings announcements tend to carry high implied volatility for the stock. That makes the options a lot more expensive. I know I mentioned that earlier, but because the options are more expensive, it makes more sense to sell options than to buy options. And there are, um, that's as a general rule of thumb, but there are exceptions to this, because if you do want to expect a large move in the underlying, that's when you'd utilize a debit spread and take on that risk. But in the case for credit spread, in the longer term, I find that credit spread just help generate a lot more premium, because you're taking advantage of the elevated implied volatility. And let's say, for example, JP Morgan did not move at all after this earnings announcement. It stays flat. What would happen is the value of the credit spread declines, which is what you want. Remember, you want the credit spread to expire worthless or to decline in value so you can buy it to close it at a later date for profit. But the value will decline even if the underlying stays put, because of the implied volatility crush. After the earnings announcement, the event that markets were pricing in that would have caused a lot of volatility has already happened, and therefore the IB crush would result in the credit spread or the options being a lot more cheaper, and you'll immediately realize a profit, assuming that the stock stays flat. So that's why I like a credit spread, because once again, it's more variables in your favor. And that's what you really want to be looking for when trading earnings, because earnings, like I said, it is still a bit of a gamble. There's very little that we can control, but it's important to realize what we can control and establish a bias, whether it be a directional bias or a bias of magnitude, and then from there, utilizing the correct strategy to trade that. So with that, that is all I have for you today. I'm going to open the floor to any questions you may have, but please use the Q&A window and not the chat window. Thank you. Will this be published on YouTube for later viewing? I believe so. Just contact Burst Trade to be sure, but I believe they usually are uploaded onto YouTube. Okay, if there's no questions, thank you everyone for joining. And um, I hope you all have a great remainder of the trading week, and I will see you next week, Tuesday, for a market outlook. Oh, wait, actually, we do have a question here. It obviously takes some time to come through. Does the company share earnings every Friday? No, that's the earnings announcement that happens once a quarter. The date is publicly available, but they only share those earnings once every quarter, along with the forward guidance, which is also very important. You know, a lot of the time, markets actually prioritize the forward guidance over the actual reported figures. I also have a feeling they might do that this time because we are approaching interest rate cutting environment, and therefore the expectation is that there'll be more consumer spending, but we want to see the companies in their forward guidance state that they are optimistic for 2024. When should you set up an earnings trade? How many days in advance? Now, I would actually set this up usually a day or two before the earnings announcement. You don't want to be paying for any additional extrinsic value. But the expiration dates are still 60 days or 45 days if it's a debit spread or a credit spread. And it's important to use that because even after the directional move, remember there's still extrinsic value to be gained or lost, and the stock could still continue to move in your favor. So that's why you'd want to keep the expiration dates, you want to be disciplined with that, using 45 to 60 days to expiration. But you'd maybe want to open the trade just before the earnings announcement, maybe a day or two before the earnings announcement. How to stop loss on a credit spread. So for the stop loss on a credit spread, that's actually a very good question. Here we go. So usually I would have a stop loss for double the premium that you received. So if you received $1.82 for per share, or 182 in total, when this credit spread has a value of double, so when it has a value of 364, oh, I've got my maths right there, yeah, 364, that's when you'd want to get out of the trade. So usually we take losses or cut losses at 100% off that premium paid. Remember, you want the value of the credit spread to decline. You don't want it to rally. I'm new to options. I've never traded options. What would be the best way to start? That's a great question. So I think speak to First Trade because we do have an array of educational webinars. But I would start at options pricing and option basics. Why, like, you want to understand why you'd want to trade options in the first place. What are the benefits? But from there, move on to how options are priced. Understand the concepts of intrinsic and extrinsic value and what impacts an options price, and then go into single-legged strategies. And once you understand and have very good grasp of single-legged strategies, you'll start to understand these multi-legged strategies like credit spreads, like debit spreads, a lot better. The risk of assignment, good question. So the risk of assignment is still, it's still fairly normal because you're using a lot of days to expiration, right? You have 60 days to expiration or 45 days to expiration. And assignment really only happens, I mean, it can actually happen at any time, theoretically, at any time if your option is in the money. But assignment would usually happen when there's very little extrinsic value left. So when the option is close to expiration and it is in the money. So that's when assignment happens. And by utilizing 45 days to expiration or 60 days to expiration, you actually have plenty of time. However, for both credit spreads and debit spreads, I always advocate for closing these at 21 days to expiration. Just to be safe, there is a bit of wiggle room there, of course, but the reason I say 21 days to expiration is because of higher theta decay and higher gamma risk for the option. That is a whole other story, though. We'll talk about that in the Greeks webinar. But 21 days to expiration is usually the best practice for when to start closing your position. Why set an expiration date for 60 days? Wouldn't you know the impact of the earnings report within a few days? Yes, you would, but you'd also be exposed to extremely high theta decay. By having it to 60 days, not only does it buy you time to think of what you want to do I want to keep this open or do I want to close it? But it also allows you it also protects you from that accelerated theta decay in the case of a debit spread where you are exposed to theta decay. For credit spreads, you have theta decay working in your favor. That is true. But let's say, for example, you sold a credit spread that has 5 days to expiration and it went wrong. Your short strike is now in the money. There's a very high chance of getting a sign as well. So that's why we still go for the longer days to expiration, but you can always close it right away if you believe that, even after the move has gone in your favor, if you believe it's going to reverse lower, you can still close it early on. Should I turn credit spread trade into a single leg of direction change, like put credit spread to expect the stock to go up, but the stock is jumping down, close a short put leg and leave the long put leg? You should never do that. And I know the temptation is there to do it because you have one leg that's doing well, another leg that's doing badly. But let's say, for example, the short put leg, that's going to be obviously in the red. It's going to be experiencing a significant loss. If you close that and you're now only left with a long put leg, that means you have a bearish bias on the stock. And that means the stock has to continue to move lower for you to start experiencing any gains, or for you to start approaching break even or making your way back to break even for the trade. And after a big move to the downside, the risk to reward favors the upside. There's a higher probability of a reversal higher. So that's why you'd actually want to avoid that. Rather go back to your original reason for the trade. You had a bullish bias on the stock, it went against you, and that's completely fine. But don't change your bullish bias to a bearish bias because the stock over the last couple of days has now gone against you. That's where you're actually adding more risk. And most of the time, I've seen people do this. They actually tend to lose more than when they were losing when they lost from the initial move and when they initially bought to close the short put leg. So that's why I always say just analyze your thesis. If it's been invalidated, close the trade and move on to the next one. Okay, so I think that's all the questions that I see here. Again, thank you guys so much for attending, and I will see you next week, Tuesday, for a market outlook. Great turnout today, everyone, and a great way to start the 2024 educational calendar. We also have a few new webinars that we will be doing for 2024 that I'm quite excited about. I know First Trade will share that with you. So yeah, very much looking forward to the year, guys. Big thank you. I will see you next week.